Welcome back. The whole idea of the American dream, it feels like it's shifted, right? For a lot of our listeners, it's less about just getting by and more about building something lasting, generational wealth.
Absolutely.
Mm-hmm.
But what is generational wealth? I think most people jump to, a big pile of cash or assets, stocks that shoot the moon.
Right, the big inheritance number. But that can feel volatile. What if there's another way, something maybe more reliable, like passing down an income stream?
That's exactly the angle we're exploring in this deep dive. We're looking at realty income, ticker O. Now, sources are upfront. This stock isn't going to make headlines for explosive growth. It's kind of boring, actually.
Boring, okay.
Yeah.
But then they also call it an unstoppable dividend stock. And it's got this pretty hefty yield, around 5.4%. So how does boring square with unstoppable and that kind of payout? That's what we need to unpack.
Yeah, there's a paradox there.
Yeah.
And realty income leans into the predictability part. Their whole identity is wrapped up in their nickname, which they've actually trademarked, the monthly dividend company.
The monthly dividend company. Doesn't get much clearer than that. Sets the expectation immediately. Consistent cash month after month.
Exactly. So if you're thinking about relying on something for, decades, potentially for your kids or grandkids,
Huh.
you need proof it works, especially when things get rough.
You need a track record.
Mm.
And realty income has a pretty big number associated with it there. 30 years.
30 years, that's 3 decades of consecutive annual dividend increases. And think about what happened during those 30 years. It's not just smooth sailing.
No kidding. I mean, you had the .com bust, sure, but then the big ones.
The Great Recession, 2007 to 2009, that was brutal, especially as the sources point out for anything related to real estate. The whole sector was just hammered.
And yet the dividend kept going up. Then, more recently, the COVID-19 pandemic.
Right. And the sources really emphasize this. The pandemic was devastating for retail. Physical stores shut down. And retailers make up, what, over 70% of realty income's tenants?
Okay, wait, that seems like a huge vulnerability. How does a company mostly reliant on rent from retailers, many of whom were closed, keep paying and raising dividends through that?
Mm-hmm. It suggests something really robust in the underlying structure, doesn't it?
Yeah.
More than just luck.
Yeah, it points to a financial setup that's, I don't know, almost crisis-proof.
Well, that's maybe stretching it, but definitely resilient. And that resilience is backed up fundamentally by their balance sheet. The sources highlight its investment grade rating. That's key.
Investment grade. So that means they're seen as financially strong, stable, can borrow money more easily, cheaper.
Exactly. That financial strength gives them room to maneuver and supports the specific way they structure their business. It's not just what they own, but how they own it.
Okay, so let's get into that structure. How does it give them an edge? We know they're a REIT, a real estate investment trust.
Right. And not just any REIT. They are the largest net lease REIT out there. That scale alone gives them advantages, better bargaining power on deals, lower cost of capital compared to smaller players.
Net lease, you emphasize that. Let's pause there because you said that's key to surviving things like COVID. What exactly is a triple net lease? How does that work?
Okay, yeah, this is really the core of it. Think about a normal rental property. The landlord, the owner, usually pays for things like property taxes, building insurance, and, fixing the roof or the plumbing, the maintenance. Those are the 3 nets.
Got it. Taxes, insurance, maintenance.
In a triple net lease, the tenant is responsible for paying all 3 of those. Realty income, as the landlord, basically just collects the rent check.
Ah, okay. So if property taxes jump up or there's a big repair needed, that's on the tenant's bill, not realty income's.
Precisely. It shifts a huge chunk of the operating risk and cost variability away from the landlord and onto the tenant. The rent check realty income gets is much closer to pure profit.
That makes sense then, how they could weather the pandemic shutdowns better. Their costs didn't suddenly explode, even if tenants were struggling temporarily. The leases are usually long-term too, right?
Yeah, often 10, 15, even 20 years. So it provides very predictable long-term cash flow, insulated from those operational costs. That's the defensive power of the model.
Okay, that's a powerful defense mechanism. And it's reflected in the kinds of properties they choose too, isn't it? Even though it's heavily retail, it's a specific kind of retail.
Right. They tend to focus on properties that are pretty standard, relatively easy to release if a tenant leaves. Think like your local Walgreens or a Dollar General or maybe a convenience store. If one moves out, the building itself is still a usable box for a similar kind of business.
So less risk of having a weird, specialized building sitting empty, plus they're not all clustered in one city or state.
No, huge geographic diversification.
Mm.
all across the U.S., and they've been expanding quite a bit in Europe, too. That spreads the risk, so a downturn in one region doesn't sink the ship.
And management seems focused on continuing that diversification, adding different property types, different kinds of tenants, but always slowly, steadily. The sources mention they're adding levers for growth without taking on undue risk.
That's the mantra. Slow and steady. They're not chasing trends. It's about reliable, essential businesses. Drugstores, grocery stores, gyms, the kind of places people use regardless of the economic cycle, mostly. It's deliberately unexciting.
Deliberately unexciting. Okay, I like that. So we understand the resilience, the structure, the strategy, but that brings us back to the yield. If it's so safe and steady, why the 5.4% payout? In the stock market, high yield usually signals high risk.
That is the million-dollar question, isn't it? And it's a fair one. Let's put that 5.4% in context first. The broader market, the S&P 500 yields what, maybe 1.2% right now?
Yeah, very low.
And the average REIT is maybe closer to 3.8%. So yeah, realty income is definitely paying out significantly more.
So what gives? Is there hidden risk we're missing?
Not really hidden risk. It's more about the tax structure of being a REIT. This is fundamental. To qualify as a REIT and crucially avoid paying corporate income taxes, a company must pay out at least 90% of its taxable income to shareholders as dividends.
Ah, okay. So it's not that they're just choosing to be generous with the dividend. They have to pay out most of their earnings.
They have to. It's a legal requirement baked into the REIT structure. The tax code basically forces them to be high-income investments.
That explains the high yield then. It's mandated.
It's mandated. Now, combine that mandate with the other side of the coin we talked about, the slow growth. Because they're paying out almost all their earnings, there isn't a lot left over to reinvest for, massive expansion or buying huge portfolios really quickly.
Right. Less retained earnings means slower growth in the actual business and likely slower growth in the share price over time.
Exactly. The market understands this. It prices realty income as a boring, slow-growth business, just like the analysts say. So you get paid a lot in dividends today, partly because the expectation isn't that the stock price itself is going to suddenly rocket upwards.
It's a trade-off. High current income versus potentially high future capital gains. And realty income is squarely in the income camp.
Totally transparent. You know what you're signing up for.
Okay, but slow growth still needs to be enough growth, right? Especially
Yeah.
if you're thinking long-term, like generational wealth.
Well,
We need that income stream to keep pace with, well, life getting more expensive, inflation.
that's the critical check. So let's look at the number. Over those 30 years of dividend increases, the compound annual growth rate, the KAGR, has been about 4.2%.
4.2% per year, on average. How does that stack up against inflation historically?
Pretty well, actually. On average, that 4.2% growth has been comfortably above the historical rate of inflation. So what that means for you, the person holding this stock, is that the actual purchasing power of your monthly dividend check hasn't just stayed flat. It's actually increased over time.
Okay, that's huge. So the income is reliable, it's high because of the REIT rules, and it's grown faster than inflation over the long haul.
That combination is really powerful when you shift your mindset from short-term gains to, like you said, building something for the next generation.
This brings us right back to that core idea, legacy. It's not about timing the market, it's about finding structures that endure.
And the proposition for realty income becomes really clear, doesn't it? You're essentially buying into this very stable, very defended income generator. It pays you well right now, that 5.4% yield, just to own it. And historically, that payout has grown faster than inflation.
So the whole wealth transfer idea changes. Instead of handing over a big, potentially complex portfolio that your kids or grandkids have to manage and worry about,
Right? And maybe make mistakes with or feel pressured by.
yeah, instead of that, you're potentially giving them a direct deposit every month, backed by real assets, shielded by those net leases, and driven by tax rules that ensure the cash keeps flowing.
It takes a lot of the guesswork and anxiety out of it. Imagine retiring, living comfortably off those dividends, and then knowing that same reliable income stream will continue for your family. It provides a baseline, a foundation.
Certainty instead of just potential, that feels like a different kind of legacy.
It really does. And that's why this slow and steady, almost boring approach has worked so well for long-term dividend investors. The structure,
Yeah.
net leases, the REIT rules, it creates dependability.
Okay, so let's wrap this up. If we boil down this deep dive, realty income's case for generational wealth rests on, what, three main pillars.
I'd say so. First, that undeniable 30-year track record, raising dividends through thick and thin, including major crises. That proves resilience.
Okay, track record.
Pillar one. Second, the business model itself. Being
Mhm.
a large-scale, net lease REIT provides that defensive structure and predictability. The risk is inherently lower.
The structure, pillar 2, and there.
The outcome of that structure. A high mandated dividend yield around 5.4% currently, combined with slow but steady growth that has historically outpaced inflation. It's the combination of high current income and growing future income.
Track record, structure, and outcome, all pointing towards reliable growing income.
Yep, all built on a commitment to being, well, boring and diversified.
So let's leave our listeners with this thought. We started by distinguishing between inheriting a pile of money and inheriting a reliable income stream. Think about what each enables. A lump sum offers potential, but maybe also pressure and risk. An income stream like this, proven over decades, built on a low-risk model. What does that offer? Maybe it's less about maximizing dollars and more about providing a fundamental level of financial security and predictability for your family's future?
It changes the conversation from how much to how stable. A different kind of freedom, perhaps?
Exactly. Stability as the ultimate legacy. Something to definitely think about. Thanks for joining us on this deep dive.
My pleasure.
We'll catch you next time.